We had a fairly strong day in the market yesterday, nearly green in every single position. However, when we zoom out and look at just the last week, it does paint a little bit of a different story. And when we take a look at the Fear and Greed Index, right now we can see we are in the greed territory. Just 1 week ago we were sitting in neutral. Bear in mind, market sentiment does change very, very quickly, but always interesting to see where investors do sit in terms of the fear and greed level. Now, we also want to point out that portfolio managers are starting to come out and say that a correction could in fact be coming over the next few days. However, what they have also noted on top of that is that they are expected to grow around 11% into 2025. However, they do also add some cause for concern that the markets have been expensive for a while, and therefore whether or not you believe that this information is correct, it is always good to consider different points, bullish as well as bearish, and most of these come essentially from the fact that they believe potentially if the US GDP growth slows, inflation does rise, something we haven't seen at the moment, then a market correction might happen. Again, just some points that we did want to bring to your attention from today. Now, in this episode, we are going to look at 7 undervalued stocks, nice upside across each one. As always, we'll look at each one in detail. We'll talk about the earnings expectations over the next 4 quarters, their historical performance, and as always, we'll touch upon not just their dividend safety, we're going to look at dividend yield theory, we're going to compare their forward PE to the 5-year average, and as always, run through some very important metrics that you need to understand for each company, like the free cash flow, like the ROIC, as well as run it through our valuation model, getting to our intrinsic value, getting to the margin of safety, 10, 20, 30% that we believe applicable for each one of the 7, and also discuss what Wall Street believe is the upside for each one of these over the next year. And as we said, each one of these 7 have at a bare minimum 20% upside over the subsequent 12 months. And the first company we're looking at is Microsoft, 52-week high of $468, and we notice Wall Street have given this a strong buy. Now, seeking alpha with the hold, bear in mind 3.5 would turn this into a buy. Same to be said for Quant. They have both given hold ratings, but again, not far off what would make this flip. Now, they do pay a dividend 0.8%, and the forward PE does sit at 31.5. For comparatives, S&P right now sitting at the 25 region. Now, over the last year, it is up around 11%. When we look at just over the last 12 months, it is down around 3.5%. But as always, with these companies, we are looking at high quality ones. And over the last 10 years, they have massively outperformed the S&P, up 764%. Remember, if you do reinvest your dividends, then the numbers that you will see here will in fact be higher. Then we take a look at their earnings expectations. Always great to see. First point, green right across the board. And this tells us that they're expecting positive growth to the EPS year on year over the next 4 quarters. And when we look at the previous 4, especially for that historical forecasting accuracy, we do in fact note they have outperformed. That is a 100% track record, giving us faith that ultimately Microsoft will be able to hit the 15.07 that they have targeted for June 2026, their next full year accounts, bringing down that forward PE to 27.4. Now, as we said, lots of metrics we're going to run through for each one of these 7. Firstly, Microsoft, 99 on the dividend safety score, indicating very safe, the highest score obtainable. We'll cover these 2 valuation metrics, but nice to report just over the last few months, they did increase the dividend at a double-digit rate, something that we do see on a very consistent basis with this company. Now, it was just reaffirmed last week, very safe, and ultimately what this means is that a dividend cut is highly unlikely. Now, for each one of these 7, we'll go through some key metrics, essentially showing how they performed during the 07-09 Great Recession. Microsoft, they maintained the dividend, didn't increase, didn't cut. Negative 9% in terms of recession sales. Now, that was marginally above the average, which sat around negative 12, and they also marginally outperformed the S&P, negative 48. During the same time, the S&P came in negative 55. As we said, very consistent in terms of their growth this year. It's been 10% over the last 5 years and 16% over the last 20. And for those that are interested, they have been increasing those dividends for the last 14 years on a consecutive basis. Now, each one will take a look at the valuation. This is on the forward P basis. The blue tunnel that we see here is the expected intrinsic price, and right now we sit in the midpoint. Therefore, based on this, you could argue reasonable valuation. Just remember, we're not looking at any one of these models in isolation. We will conclude towards the end. Now, dividend yield theory states a company is undervalued when the current yield sits above the 5-year average. We don't have Microsoft above, but it isn't too far off, so you could argue reasonable valuation. The same thing you could argue on the forward P, 31.3 against 31.5, again, very, very similar. Although what we do notice with this company, they do trade higher than the information technology sector, so right now they're trading at a premium. Is Microsoft worth it? We do believe so, especially when you do compare their metrics against the sector median. Question is, how much of a premium are they worth? And that is what we will cover when we come to the margin of safety. Now, free cash flow is something we always draw your attention to over the earnings. It is susceptible to manipulation by management through accounting, and below 60% is what we ultimately target. Reason for this, we want to have faith that management are able to continue with double-digit increases. Not only is it below 60%, but it's been decreasing 30% in 2024 and a marginal increase over the next 12 months. So September 2025, we'd be very surprised if we don't get another double-digit growth rate. We then move on to the free cash flow per share, where we want to see consistent increases over the longer term. Nice to note they've pretty much tripled from 2015 to 2024. Although we do have to highlight over the next 12 months, it is anticipated to come down to around $9.40. We also like the sales growth of Microsoft. Typically, we want to see 3 to 7% year on year. Remember, 3 to 4 at the bare minimum, just to keep up in line with inflation. Numbers looking very good for the large part, double-digit rate, including the more recent year at 24%. And when we do zoom out, we can see nearly tripled their top line from 2015 to 2024. Now, one thing we like to keep our eye on are companies that do share buybacks, returning excess cash to investor pockets. Not something that Microsoft do on a very consistent basis, and not something in the shorter term we can see they have done. But over the longer term, they still have bought back some shares. What we take from this is that part of their capital allocation, doing share buybacks, isn't one of their top priorities. However, double-digit increases to the dividend clearly is. ROIC, one of our favorite metrics, 10% or more, give us faith management are able to effectively allocate their capital. Very good numbers, double digit across the board, 30% in 24, 29 on a trailing 12-month basis. We do like this, as well as potential investors will look to these numbers and be very, very happy. Now, operating margin, not only do we want to see it above the minimum 12% that we get, but we want to see operating efficiencies. Remember, 2 high-quality criteria for companies: increase revenue, increase margins, something that we clearly see from Microsoft, 30% in 2015, 44 on a trailing 12-month basis. And we love the consistency of the free cash flow here, truly a free cash flow machine, 30% in 2024. Again, very, very good numbers. No surprises that this is clearly a high-quality company. We then move on to the net debt to EBITDA, referring to the earnings before the interest, tax, depreciation, amortization. Below 3 is what we want to see. That is what we get. And remember, the numbers below show us the number of years it would take the company to pay off all of their debt net of cash on hand. And why we highlight this metric every single time, it correlates to dividend safety, balance sheet strength. Pretty much, it wouldn't take them that long to pay off all of their debt net of cash on hand. 0.13 on a trailing 12-month. 0.12 anticipated over the next 12. So very, very strong balance sheet, and definitely one of the criteria we look at before executing on any company. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, how we got to the intrinsic value is running it through the DCF model. Now we're going through a lot of companies today, so we'll just show you for Microsoft how we got to it. The rest we will go through very briefly. We get the free cash flow per share on the DCF model. The average growth over the last 10 years has been 14%. Now we've got a rate here of 16, which we've taken as the median rate, 14, 16, and 18. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see here, 494 indicating 20% upside. But do also remember, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Microsoft or any others. But as always, we'll show you for transparency. For example, if you believe 14% to be more appropriate, $430, 4% upside. And for those that are more optimistic, 18% indicating 567, 38% upside. So we'll take through the median rate today at 16%, and when we do run it through this calculation, we always like to add a margin of safety, which we execute on companies at the 10% rate if in fact they meet our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode we'll buy at $445, then we keep going till it's near the current trading price. Now it's not quite there at the 20% level at $395, but right now we see Microsoft between 15 to 20%. With Wall Street, their price target over the next year not far off our intrinsic value calculated at $494. They see 21% over the period. So 15 to 20% MOS, Wall Street 21% upside over the next year. Give us your thoughts below if you believe this is a buy, maybe a hold, or in fact you have recently sold. We also want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox where we cover severely undervalued stocks that we believe deserve your attention, as well as what's gone in the market over the last few days. So click below, sign up, you can read straight away. You'll also be able to gain access to 40 undervalued stocks for the month of November. Lots of information for each one, the upside as well that Wall Street see over the next year, and on top of that, a newly released spreadsheet targeting 29 undervalued dividend stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, sign up, and you can start reading straight away. The next stock we have is Adobe, where we get a strong buy rating from Quant, a double buy from Seeking Alpha and Wall Street. So pretty much all ratings in unison saying that this is definitely one to consider for the portfolio, trading towards the lower end of the 52-week range. Now it doesn't pay a dividend, although it historically did, and has a forward PE just below 28, down 18% thereabouts over the last year. Over the last 10 years though, massively outperformed the S&P, up 578%. Now nice report, over the next 4 quarters they are expecting some strong growth to the EPS, and also great to see historical forecasting accuracy 100%. In turn, if they hit their expected 2056 for November 2025, the forward P will come down to 24.53. Now, as we said, they don't pay a dividend currently, although they historically did. You would have to go back quite some time away. And when we do take a look at the first metric for Adobe, it is the free cash flow per share, which looks very good, nearly 7-fold increase from $2.29 in 2014 to $15.20 in 2023, and a large jump is anticipated to the free cash flow over the next 12 months. Sales growth also looking very good, bar 2014, double-digit increases to the top line every single year, 11% on a trailing 12-month. And for those that like to see the numericals here, we can see nearly 5 times increase from 2014's $4 billion to 2023's $19.4. On top of that, they have done some share buybacks, in fact reducing their total shares by around 10% from 2014 to the latest quarter, so that is a nice added bonus. Yes, they don't pay a dividend anymore, but nice to see they are returning excess cash through those share buybacks. And ROIC looking very, very good, not only increasing, but in the 30s over the last 3 years, 36% on a trailing 12-month. This is something we do like to see, as we said, one of our more favored metrics when we decide on executing on any stocks. Again, operating margin, as you can clearly see, operating efficiencies, 10% in 2014, 36 on a trailing 12-month, and the free cash flow does look very, very good. Definitely a free cash flow machine, something again we do love to see in companies we consider. I mean, continuing with that same theme, we also like to see this as well, the net debt to EBITDA over the last 4 years, over the last 12 months, over the next 12 months expected, 0 right across that period, indicating to us not even 1 day for Adobe to pay off all of their debt net of cash on hand. Now getting to our intrinsic value of $580, as we said, 10% MOS is the starting point, a buy at 522. At 15%, not quite there yet, not far off. So for this company, we see 10 to 15%. For someone who wants to see at a larger MOS, at 20%, you would have to wait for 464. At 25, 435. Right now, though, as we said, between 10 to 15%, we do like this company. It does have a lot of very strong metrics that we briefly touched upon. And Wall Street, very bullish, 24% upside, price target $625. So they believe you should be considering this stock more than Microsoft. As we saw, they believe a little bit more upside, and give us your thoughts below. One, whether you believe this is a better stock to buy right now than Microsoft, and in fact, if you've been buying, maybe holding, or considering selling. We then move on to AbbVie with a double buy rating and a hold from quant. We notice this is trading in the mid to lower end of the 52-week range. We have a nice yield of 3.91%, a nice forward PE just below 16. Now over the last 12 months, it is up around 24%. When we look at over the last month, it is down around 9%, something we have covered in a not too long ago episode if you do want to check that out. Over the last 10 years, up around 143% and outperformed the S&P 500. Again, continuing the theme with the previous two stocks, over the next 4 quarters, they are anticipating growth to the EPS year on year. However, out of the previous 4, they only have a 50% track record, 2 out of 4 beats. Nice to see though the more recent one was an 8-cent beat to the earnings per share. And if they do hit that December 2025 figure, forward P will come down to 14.14. Nice to report, dividend does look to be safe with a score of 80, and they did increase the dividend just last month, 5.8%. As we always say on the channel, ideally get a minimum of 4%, just to keep up in line with the historical inflation rate. Now the key metric we do have here is that they had plus 10% sales. Remember the S&P was a negative 12. Now we did get a marginally above inflation increase last month, but over both the last 5 and the last 10 years, they have been historically increasing the dividend at a very, very attractive rate, and they're also a dividend king with 50 plus years of consecutively increasing the dividend, but on top of that, they've been paying a dividend for the last 100 years without a reduction. Now, when we look at this valuation model over the last 12 months, we actually see it been trading at overvaluation right now within the blue bucket. So solely on this model, it does give us a sense of reasonable valuation. When we take a look at dividend yield theory, again, depending on how you see it, reasonable valuation, slight overvaluation. Forward P, however, does trade at 14.5, which is significantly higher than the 5-year average of 10.5. Although we do have to say it does trade at a discount to the healthcare sector at 15.8. Now, in terms of the free cash flow payout, we want to see below 50% for biotechs like AbbVie. We pretty much get that. It has straddled around that year on year and expect it to continue over the next 12 months to 53%. Now, free cash flow has also been increasing over the longer term. 184 10 years ago, 1250 in 2023. Expected to be flat though, bear that in mind, over the next 12 months. And some of these things that we do point out, you can always add a little bit extra in terms of the margin of safety. As we said, sales growth 3 to 7%, something they've done very strongly when we do zoom out. However, 2023 wasn't the best year, down 6%. And when we do ultimately zoom out, they still have doubled their top line, or more than we should say, from 20 billion in 2014 to 54 in 2023. We do also, however, have to point out that they have been diluting your position, although minimally over the longer term, increasing those shares outstanding, issuing equity 1.61 to 1.77 in the latest quarter. ROIC, something we do keep a close eye on, above 25%, so quite high for biotechs, and we can see more often than not straddling around that 24 in the more recent annual accounts. And then when we get to the margins, whilst we don't see efficiencies, we do see some very high numbers here, well above the minimum, which is always a good sign to note, and the same to be said for the free cash flow, so we don't have any red flag indicators that we do want to point out for this company so far. But then we get to the net debt to EBITDA, below 1.5 is what we want to see. Now, over the last 12 months, it is fairly high at 2.52. Nice to see it coming down over the next 12, but ideally not something we've seen since 2014, but we do want to see it below that. Remember, it does correlate not only to dividend safety, but also balance sheet strength. Now, our intrinsic value, $195, based on the current price today, at a 10% MOS, a buy at 176. At 15%, it isn't quite there yet. Maybe we see that over the coming weeks. Remember, with the news of RFK being appointed as HHS, that did take the overall sector down a few levels, so maybe one to put on the radar, but between 10 to 15% is where we currently see it. Some people, though, will find that sufficient, will start adding. Wall Street, on the other hand, they have a higher price target, $206. They believe this has 20% upside from today's value, and don't forget, you are also getting a fairly attractive yield around the 4% level, and give us your thoughts, as we said, for each one of these below. We then move on to Amazon, which has come down below the $200 mark. We have a strong buy rating from Wall Street, a buy from Seeking Alpha, and as we always mention, yes, quant have given it a hold, but 3.49 is literally 0.01 away from flipping to a buy. Now, no dividend has been paid, but maybe we will see the likes of Amazon following the footsteps of Meta Platforms and Alphabet that have recently started to pay a dividend. Forward P 39, we do sit at the upper end of the 52-week range. As we said, we do note a pullback from the all-time highs of $216. Over the last 12 months, well, up 38%, outperformed the S&P. Over the last 10 years, again, outperformance up more than 1,086%. Now, no surprises, they're anticipating double-digit growth to the EPS over every single quarter, and quite large in that as well. And also, they have massively outperformed analyst targets, so a 100% track record, with EPS anticipated December 2025 to hit 6.15, there in turn lowering the forward P to 32.8. Now, in terms of free cash flow per share, bar the 21-22 where we do see it negative, it has gone up at a very consistent rate and expected to propel up, in fact, nearly double over the next 12 months to $5.99 per share. Sales growth also looking very good. 9 of the last 10 years have been double digit, including 2023 at the 12% point. In terms of numerics, well, absolutely phenomenal, nearly 7-fold to their top line from 2014 to 2023. Trailing 12 month also showing that 2024 will be another strong year. But again, we do have to point out they have been diluting your position as a shareholder over the last 10 years with the increase. But bear in mind, you probably wouldn't care if you did invest in 2014, as you would have massively, as we've shown, outperformed the S&P. ROIC, we would like to see some consistency over longer term, but if we look at the short period, 2023, and on a trailing 12 month, it is above that 10%, locking in at 15%. Operating margin, yes, we do get operating efficiencies. As we can see, it has increased from 0% in 2014, in fact 2% from 2015 to 6% in 2023, 10% as well on a trailing 12 month. But remember, for this, at the very bare minimum, we do want to see 12 to 16%. Free cash flow margin, minimum 5%, and that is pretty much what we get near enough every year. 7% on a trailing 12 month does show a little bit of an increase. Maybe we will start to get further increases moving forwards. Net debt to EBITDA, it isn't similar to the likes of Alphabet where we get 0 across the board, but nonetheless 0.48 over the last 12 months, expected to go lower over the next 12, does signal the balance sheet does look to be very, very strong. Now our valuation, $226, when we do run it through the MOS at 10%, a buy at 204, at 15% around 193. Now it's not at that level yet, it is sitting somewhere between 10 to 15%, but a lot of people again will believe that that is still a great price for a Mag 7 with some phenomenal metrics as well. Wall Street even more bullish than us, and their price target $240, they see upside of 21% over the next 12 months. We then move on to Ulta Beauty, one that we saw Berkshire Hathaway buy and then sell the following quarter, or the majority of that stake. We get a double buy, hold from Quant, trading pretty much near its 52-week low, a forward P of 14.65, and when we take a look over the last year, down 16%. Over the last 10 years though, it has around a similar performance of the S&P, up 165, and we can see such a massive pullback from its all-time highs at $575. Now we do notice over the next 4 quarters they are expecting everyone to be a decrease, and they did miss their more recent quarter. However, 75% track record, the previous 3 were beats. We do need to make you aware over the next full year earnings per share is anticipated to come down, although marginally. Forward P as well, therefore rising to 14.92. Again, that is also marginal. Now, in terms of the financial metrics, massive growth, nearly tenfold from 2015 to 2024 in terms of the free cash flow. Do bear in mind a marginal drop is anticipated though over the next 12 months. Bar COVID, which had an effect on this company, no surprises there. They have been reporting double-digit increases to their top line year on year, although fairly inconsistently. And therefore, when we do zoom out, they've nearly quadrupled their top line from $3 billion in 2015 to $11 billion in 2024. One thing that management do focus on here are returning excess cash through share buybacks, something they have done fairly aggressively over the last 10 years, and something we do believe they will continue as it is a priority for them in terms of their capital allocation. No complaints whatsoever on the ROIC, very, very strong numbers. We don't get this that often, 39% in 2024. And whilst we don't get operating efficiency on the margins, we still notice straddling around the 16% that we want to see for the industry. Free cash flow margin as well looking good above that minimum 5%, 9% in fact in 2024. Net debt to EBITDA, again reflecting a very strong balance sheet, 0.49 in 2024, and even with the increase expected over the next 12 months to 0.73, this still gives us faith their balance sheet does look very, very strong. Now, there is a bit of a disparity between our intrinsic value and Wall Street. Nonetheless, they see the price over the next 12 months at $410, upside of 22%. When we run it through our MOS, we'll at 10%, a buy at 433, at 15 at 409, and then as we keep going, what we notice in fact in today's episode for Ulta Beauty, we see it right now bang on a 13% margin of safety. Now, there is a lot to consider with this company, and therefore you may believe that 30% is appropriate. For those that want more, at 35, a buy at 313, at 40, around 289. And as we said, do give us your thoughts. 30% MOS for Ulta Beauty, 22% upside from Wall Street over the next year. We then move on to Thermo Fisher Scientific with a double buy, again a hold from Quant. This one is also trading towards its 52-week lows, on the lower end for the yield at 0.3%, the forward P marginally lower than the S&P at 23.8. Now, over the last year, only up around 7%. Over the last 10 years though, massively outperformed the S&P, up 296%. Now, what we do like about this, they are anticipating growth over every single quarter, and they have a 100% track record, so we can have some faith that they will hit their December 2025 EPS 23.55, lowering the forward P to 21.91. Now, we get essentially a safe score, 72 on the dividend, and we also notice two undervaluation signals with a very attractive double-digit increase, 11% in February this year. Now, the last recession, they paid no dividend, no comparative data, above average growth, and they also marginally outperformed the S&P, negative 45%. Very consistent and attractive dividend growth, with them paying an increase of 9% every single year over the last 10 years, and we notice 6 years of consecutive increases whilst paying a dividend for the last 11 without a reduction. Now, in terms of over the last 12 months, we actually notice it has been at the upper end of the expected fair price. Right now, it is sitting at the lower end, if not out, therefore giving us the undervaluation based on this model. And when we look at dividend yield theory as well as the forward P, both essentially telling us this company does look undervalued. In terms of comparing it though to the healthcare, it does trade at a premium. Thermo Fisher 22.6, healthcare at 15.8. Now, no surprises that they have offered very attractive dividend increases. Just look at that payout, pretty much below 10% nearly every single year, 7% on a trailing 12 month. And whilst it has been very, very inconsistent, nonetheless, we do see growth more than 3 times from 2014 to 2023 on the free cash flow. Nice jump is anticipated over the next 12 to $22 per share. Again, whilst inconsistent, their top line does look very good. We do have to point out the drop of 5% in 2023, and when we do step back and zoom out, we can see near enough it has increased threefold from 17 billion to 43 in 2023, and I would have to go and say buying back shares isn't a priority. Some years, in fact, they have also issued equity, so there is very minimal movement over the last 10 years on these figures. ROIC, looking good, nothing fantastic. Remember, near 10% is what we want. Has been decreasing from the highs of 2020, 9% noted in 2023 and on a trailing 12-month basis. No operating efficiency notice on the margin, but we can sit above the minimum 12%, and the free cash flow does look very good, and this is one metric where we do clearly see that consistency throughout. We then move on to the net debt to EBITDA. Below 3 is what we get, although it isn't too far off, 2.62 on a trailing 12 month, something just to bear in mind. Whether or not you apply it in the margin of safety is completely up to you. And our intrinsic value, unlike Ulta Beauty, is actually lower than Wall Street. They believe it is higher. 657 is what they target over the next year, upside of 29%. And with our intrinsic value of 619, when we do run an MOS through, what we in fact note right now, we see this company not at the 20% level just yet, sitting somewhere between 15 to 20. As we said, Wall Street though, on the other hand, are a lot more bullish. Do give us your thoughts below. We then move on to AMD Advanced Micro Devices with a double buy rating and a hold from Quant. This one does trade towards the 52-week low. Now, it has a forward P 41.3, which is fairly high, although lower than Nvidia for those that want a comparison. Over the last 12 months, up 15%. Over the last 10 years, massively outperformed the S&P, up 4,788%. But do bear in mind, past performance is not reflective of the future, so don't take that into consideration for that aspect of your investment thesis. Now, they are expecting massive growth, in fact, double digit, very high on a quarter by quarter over the next 4 quarters. And we can also see 100% track record looking back. Ultimately, massive growth is expected, which will lower massively the forward PE to 26.77. Now, free cash flow per share has been very inconsistent over longer term. Bear in mind, you can argue the industry is cyclical, but for some companies, we don't see the cyclicality shine through the numbers as much. And whilst it has lowered year on year from 2021's 2.65, over the next 12 months, it is expected to drive up very rapidly to $3.80 per share. In terms of sales growth, again, inconsistency showing through. Some years very good, some years very poor, in fact negative, like 2023. However, when we do zoom out, we can see more than quadrupled from 2014 to 2023. But yes, look, they have diluted your position over the last 10 years. But as we mentioned on a previous company today, you really would not care because they have massively outperformed the S&P during the same time. ROIC, very inconsistent. We do not like to see this. In fact, last 2 years have been very low single digit. Something to bear in mind because historically we have seen some very strong numbers from advanced micro devices. And then we get to the operating margin and the free cash flow. Both are showing very, very high levels of inconsistency throughout. Some people won't like that, will be put off. Others will take that and believe moving forwards, management can turn this around, especially with how strongly the industry has done over the last few years. And net debt to EBITDA, probably our favorite metric from this company. 0 from 2019, 0 over the next 12 months anticipated. Very, very good. As we said, not even 1 day to pay off all of their debt net of cash on hand. Now, our intrinsic value, $189, not far off Wall Street, so we are in agreement today for AMD. They see upside of 36% over the next year. And when we run it through the MOS, well, 10%, a buy at 170. And as we keep going in today's episode, what we find out for advanced micro devices is that we're not at the 30% level just yet. We're sitting between 25 to 30%. As we said though, Wall Street very bullish, 36% upside over the next year. As always, give us your thoughts in the comments below, whether you're adding to any of these 7, maybe holding, or in fact, maybe you have sold or are looking to sell. If you enjoyed the episode, value was provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter by clicking on the pinned comment below and joining us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.